Do you know a machine sets the price of most stocks you touch? In 2025, 70% of US trades run without a human clicking. Traders called it progress, but regulators called it dangerous. So how did code replace Wall Street itself? Today we uncover the algorithm that controls Wall Street. The truth might shock you. Join us. Let's uncover. There's a warehouse in New Jersey that shapes your money more than any president or bank CEO. No gold, no trading floor, just humming machines deciding trillions in silence. The NASDAQ data center in Secaucus looks boring from the outside. Beige walls, no sign, no glamour. But inside, air conditioners scream 24/7 because the most valuable real estate on Wall Street today runs at 18 degrees Celsius to keep machines alive. These servers buy and sell stocks in nanoseconds. A nanosecond is 1/1,000,000th of a second. A blink takes 300 million of them. Back in the 1980s, markets sounded like chaos. Traders shout, wave, sweat, and negotiate with eye contact. By 2005, most of that disappeared. Screens take over, then scripts take over, then machines take over the scripts. Today, 70 to 75% of all US stock trades happen without a human clicking anything. No gut instinct, no debate, no hesitation. The arms race begins when trading stops being about logic and turns into speed. If you can see market data 1 millisecond before competitors, you win. How small is 1 millisecond? If a surgeon reacted that fast, they could blink 400 times during an operation and lose no time at all. So firms start drilling straighter fiber optic cables under rivers and highways. But fiber physics has limits. Light slows inside glass, so they build microwave tower networks, bouncing signals through open air from Chicago to New Jersey. One tower chain, built by a company called McKay Brothers, costs an estimated $300 million, only to gain 2 or 3 milliseconds. No normal business does math like that. Who plays this game? Names you never see on billboards. Citadel Securities executes nearly 1 in 4 trades in US stocks. Virtue handles tens of millions of trades a day. Jane Street trades more ETFs than most banks trade stocks. Jump trading builds technology so fast, even competitors imitate their wiring layouts. Here's the twist most people miss. These firms care less about what you trade and more about trading before you trade. They study patterns, order flow, timing gaps, human hesitation, and market rhythm. They aim to be the market's first breath, not its echo. So while the world talks politics and inflation and crashes, the real game already happened in thin cables and microwave beams long before anyone checked a portfolio app. The strange part? Speed changed the game, but code is about to change the species entirely. Wall Street made a decision in the late 1980s. It wants less instinct and more math. So instead of hiring traders, it starts hiring astrophysicists, statisticians, code thinkers, and puzzle solvers. It began quietly in 1988. A former Cold War codebreaker named Jim Simons, a mathematician who once cracked secret messages for US intelligence, opens a hedge fund in Long Island. He calls it Renaissance Technologies. No shouting traders, no emotional bets, just data, patterns, and pure logic. Most investors laugh early on, but by 1998, they stopped laughing. His medallion fund returns 39% after fees every single year on average. Then, from 1988 to 2018, the fund posted a 66% annual average return before fees, the best long-term track record in finance history. For comparison, Warren Buffett averages about 20% in the same era. Simons does triple that with math alone. People wonder, how? The answer sounds simple, but costs billions to pull off. He hires scientists who speak equations better than English. Top code minds sit next to linguistics experts, chess champions, particle physicists, even a speech recognition pioneer. They hunt patterns like meteorologists track storms, except storms you can't see. Then others start copying the formula. D.E. Shaw, founded in 1988 too, recruits graduates from computer science labs, special operations labs, and early AI projects. 2 Sigma opened in 2001 and builds models that scan news articles, market prices, satellite data, shipping traffic, weather shifts, and consumer behavior all at the same time. Their pitch changes. Wall Street forever. Markets aren't moved by opinions. Markets are moved by signals. So trading desks slowly empty out. Physics replaces finance degrees. Quiet engineers replace loud personalities. One quant trader said in 2006, "We eat data for breakfast and markets for lunch." That quote spreads like gospel. But something else happened that year. These firms stop competing on who predicts better. They start competing on who predicts first. It turns the market into a time battle, measured in microseconds. So math starts the war, but speed becomes the weapon. However, the most dangerous moment comes when even the coders stop understanding the code. Because by 2010, a single automated decision wipes out $1 trillion in 36 minutes, and almost nobody sees it coming. The real question is this: if a market can collapse faster than regulators can speak, who rescues it from itself? On May 6, 2010, the U.S. stock market wiped out $1 trillion in 36 minutes. No bombs, no war, no scandal. Just code running faster than humans can blink. At 2:32 p.m., it starts small. A large investment firm places a massive sell order, 75,000 E-mini futures contracts worth $4.1 billion, programmed to sell automatically at any price. No human pauses it. No one checks the outcome. The algorithm follows instructions without hesitation. But the market reads that flood as panic. Therefore, trading bots sense danger. They react like startled animals, but a million times faster. They also start selling. Prices drop. Machines read the drop as more danger. They sell even more. Then the loop feeds itself. Selling creates fear. Fear creates selling. No person pulls the brake. Within minutes, Dow Jones fell 998 points, the biggest point crash in history at that time. Procter & Gamble shares plunge 37% in seconds. Accenture stock drops from $41 to 1 cent, then jumps back up just as fast. One trader later calls it a digital stampede with no exit. Humans watch helplessly. CNBC anchors sound confused on live TV. Regulators scramble for answers they do not yet have. So the machines are not acting smart. They are acting fast, and speed turns predictable actions into chaos. After the crash, the SEC spent 5 months investigating what happened. Their 104-page report concludes something blunt. No single person caused it. No single bug caused it. No villain pressed a button. The design itself allowed it. The system moved too fast for humans to supervise. But this is not the last time code breaks Wall Street. 2 years later, in 2012, a trading firm named Knight Capital pushed a software update at 9:30 a.m. when markets opened. Within 45 minutes, the mistake buys and sells stocks at a pace nobody can stop. Losses hit $440 million before engineers killed the system. The company nearly dies that day. Its stock drops 75% in 24 hours, all because one piece of code deploys with a flaw. No hacker, no villain, just one untested update. So the big question shifts. If a mistake can erase a century-old firm in under an hour, what happens when the next failure comes from a system that teaches itself, rewrites itself, and no human fully understands the logic anymore? A system already trading more than $10 trillion a day. By 2016, hedge funds managed $1.5 trillion with machine learning models instead of traditional math. By 2020, more trades come from AI predictions than human decisions. This is the turning point. At first, algorithms simply follow rules. Buy if X happens. Sell if Y happens. Fast, but predictable. However, AI changes the game. Neural networks do not follow rules. They learn. They adapt. They test millions of patterns before the market even opens. One quant fund runs 10 million trading simulations every single night. Another trains models using 25 years of tick-by-tick market data. Every price move, every volume spike, every panic moment. Humans struggle to read one chart. These systems digest entire decades in seconds. But the real shift starts when AI stops looking at the market alone. By 2019, firms will begin feeding models with satellite images of Walmart parking lots to predict sales. They track 58 million cars per quarter. If parking lots get fuller, AI buys retail stocks before earnings reports drop. Hedge funds also scan credit card transactions, cargo ship GPS routes, weather data, job postings, even energy usage outside factories. Then, social media becomes a signal. In 2021, sentiment models read 3.2 billion posts per day across platforms to measure public mood. Angry retail investors moving together trigger different trading responses than calm institutions placing orders. Therefore, the competition evolves from fast trading to smart prediction. By 2023, AI reaches a milestone most people miss. It begins writing its own trading strategies. No human manually designs the logic. Engineers simply set goals and risk limits. The model builds everything in between. One head of research at 2 Sigma admits something stunning. We deploy models we cannot fully explain. That sentence changed the meaning of competition. Because the smartest firms no longer fight other firms. They fight systems learning faster than the people who launch them. So now, Wall Street reaches a new divide. On one side, humans making guesses. On the other hand, AI makes forecasts based on millions of hidden connections no person can map. But the bigger question looms: if machines can design and trade strategies humans cannot reverse engineer, who actually owns the decision when $21 trillion of institutional capital begins flowing through a single AI risk system used by the same handful of firms? In 2024, roughly 40% of all U.S. retail stock trades run through one company, Citadel Securities. Not a stock exchange, not a public service. One private firm handled almost half the order flow. Most people trade through apps on their phones. They tap buy and assume the market handles the rest. But the trade almost never goes to the open exchange. Instead, companies like Citadel, Virtu, and Jane Street often sit in the middle. So here is how it works. You send an order to buy shares, then the broker silently sells that order data to a market maker. That system is called payment for order flow. In 2022 alone, brokers collect more than $3.8 billion selling retail trade data instead of charging commissions. Therefore, the real customer shifts. The trader feels like the client. However, the paying partner becomes someone else. Market makers promise better prices and faster execution. Sometimes they deliver. But they also learn from every trade, every click, every guess, every mistake. Their models study patterns millions of times a day. They detect who trades on emotion, who hesitates, who panic sells at 9:31 a.m., and who always buys the dip. Meanwhile, in a different corner of Wall Street, a system called Aladdin analyzed risk for some of the largest institutions on Earth. Built by BlackRock in 1988, it starts as a simple risk monitoring tool. Then it grows. Today, it influences or watches over $21 trillion in assets. For context, the U.S. GDP in 2024 is about $27 trillion. That means one platform touches a pool of capital close to the size of an entire nation. So the structure transforms. Exchanges once match humans to humans. Then humans trade against machines. Now machines mainly trade against machines. Retail orders become the training data. The battleground becomes invisible. The players become code. By 2023, nearly 90% of S&P 500 liquidity at certain hours comes from algorithmic market makers, not human traders placing long-term bets. So the question stops being who trades the market. The real question becomes who trains the machines that influence nearly half of all retail orders and tens of trillions in institutional capital without ever facing an election audit, or shareholder vote. By 2025, at least 9 major hedge funds trade with 0 human hands touching execution. No trader clicks, no analyst confirms. The system reads, decides, and fires orders alone. That shift feels quiet to the public, but inside finance, it sounds like an alarm. In the 1980s, trading floors screamed. In the 2000s, traders stared at screens. By 2020, screens watch traders. Now in 2025, the screens trade with each other. Therefore, the human role shrinks from decision maker to spectator. The first fully automated hedge fund to cross $1 billion using no manual execution does it in 2021. That fund, called EekBot, runs strategies built with IBM Watson AI, but by 2024, that milestone looks small. Firms like Two Sigma and Citadel deploy AI that rewrites its own models mid-market. No human edits, no overnight risk approval. The models evolve while trading live capital. But here's the twist. The people running these firms often admit something surprising privately. They no longer fully understand why the AI makes certain trades. So a new problem appears. If a system makes money, nobody stops it. If a system breaks the market, nobody can fully explain it. Regulators read code like a foreign language. Politicians debate it years too late. However, the machines trade every morning at 9:30 a.m. sharp. Meanwhile, retail investors live in a slower universe. Humans react in seconds. Markets now react in microseconds, 1/millionth of a second. By the time a person reads news on their phone, firms like Jump Trading already trade 100,000 reactions ahead. So the fairness question changes shape. The old debate asks if markets are manipulated. The new debate asks if markets are even built for humans anymore. A 2024 SEC study hints at the scale. Over 96% of price movement in the first 30 seconds of major news events is algorithm-driven before human orders enter the tape. So most of the real market already moves before humans officially arrive. And that raises a deeper question. If AI already sets prices before people react, then what happens when a system emerges that predicts market movement with 94% accuracy on short time horizons, faster than regulators can even validate the claim? If you think you know the market, the next story shifts the ground.